this problem, we are going to be going through a bond amortization and journal entry problem. So the data set, the description it gives to us, is that Joe has recently started his internship at SJP Investing. Part of the responsibility is to prepare the amortization schedules and the journal entries needed for each bond they invest in. This year, the company is trying to determine whether they want to continue using straight line for bond amortization or switch to the effective interest method. To make this determination, Joe's manager wants him to prepare an amortization schedule and journal entries under both methods. So here's the important, relevant data that we need. Assume that this bond has a face value of $80,000, sold at 108%, has a stated interest rate of 10%, and a market rate of 8%. They pay interest on an annual basis. We need the journal entry to record the initial issuance of the bond, all 5 years of interest payments, and the eventual retirement of the bond. So requirement 1 is going to be to complete the bond amortization schedules for both methods. So we have straight line and effective interest method. First thing we need to go back to, assume that this bond has a face value of $80,000 and it's sold at 108%. What that essentially means is that it's sold at a price that's 108% of the face value. It's above 100%, so it's a premium. So our sale is going to be $86,400. That's the starting carrying value for this bond. So it is a premium. And remember, we have the 10% interest rate and the 8% market rate. They pay interest on an annual basis. So let's go to the straight line table first of all. So this straight line amortization schedule shows us period 0, which starts off with the beginning value of $86,400. Of course, that first period, there's no cash interest paid. We're not dealing with a premium or discount amortization or interest expense for that year. What we do have, however, is the $6,400 of unamortized premium or discount. The ending carrying value, it's the same amount for this first year. So period 0 just gives us the balances that we start with. Now let's take a look at the cash interest paid. So for this one, we have to go back. It's an $80,000 face value bond, and we pay interest at 10%. So that cash interest paid is going to be 10% of $80,000, which is $8,000. It doesn't matter what the carrying value is, we are going to pay $8,000. Now, under the straight line method, what we do here is we take a look at the premium in this case, and we amortize it equally over the 5 years. So if we take the $6,400 divided by 5 years, we're going to get approximately $1,280. Now, these are rounded numbers, by the way, so we're going to get the $1,280. Now, the good news is we can calculate the cash interest paid, and for that matter, the premium or discount amortization. It's the same amount for every year under the straight line method. Now, the interest expense is going to be, since we're dealing with a premium, it's going to be the difference between the $8,000 and the $1,280. When you have a premium, this reduces interest expense. And we'll see why when we get to the journal entries. But the interest expense is only going to be $67.20. So the cash interest paid would be a credit to cash. Interest expense is obviously going to be a debit. Premium starts off with a large credit balance. So to amortize it, to use it up over the years, we have to debit it. So we have two debits that have to equal this one credit. That's the easiest way to think of that. Now, every period, we're going to take away the $1,280 that we just amortized that year. So you could actually move that all the way down to the end, and at the very end, you should end up with a 0. Now, again, the numbers were rounded, so it's kind of surprising we didn't have a few dollars left over, but in any case, it would be 0 at that point. Now, the ending carrying value, a couple of ways of looking at this. You could take the beginning value and subtract out the premium or discount amortized, because keep in mind, we eventually need to get down to $80,000, so we have to subtract that amount out. Now, that would be the very same as just taking the $80,000 face value plus the current unamortized premium or discount. It's going to give you the same result. So let's do it that way for the others. So we'll just keep doing the same thing. 80,000 plus whatever our unamortized discount is. And of course, the beginning balance would be last year's ending balance. So when all is said and done, we have the same cash interest paid, premium amortization, and interest expense each year, and the carrying value eventually at the end of the year hits, the end of the 5 years, hits $80,000. So that's what we're looking for in this particular problem. So remember, straight line, your three amounts are going to be the same. So let's start off with the effective interest method here. So again, we start off with our beginning balances. The difference here is not going to be in the interest paid. That's actually going to be the same amount under a straight line. The cash interest paid is set by the contract. So that will not change throughout the 5 years. However, you know, before we calculated the premium amortization, that was the first thing we did, and then we went to the interest expense. Under the effective interest method, you start off with the interest expense, and then you back into the premium amortization. The interest expense is actually going to be the beginning carrying value multiplied by the stated rate, multiplied by the effective rate for that period. That's where it gets the name, the effective interest method. Now in this case, the market rate was 8%. So let me get rid of that. It would be 0.08 multiplied by the beginning carrying value. So 69.12. Now, again, the premium is still going to be the difference between cash interest paid and interest expense. It was the other way around in the straight line. The interest expense was the difference between the first two. Now we've just, I guess in either way, the interest expense and the premium amortization have to equal $8,000. So that's not a question. So now the unamortized premium, it was $6,400. Now we've amortized $1,088 of it. And our ending carrying value is now, again, you could say beginning minus the premium amortization. That's one way to do it. And then your beginning value for the next year is this year's ending value. So now we can carry that formula down. It's still going to be 8% multiplied now by 85,312. And the difference is 1175 now. Now we only have 4137 left for the unamortized premium. We started with 5312, took away 1175, and now we're down to 84,137. So again, now for interest expense, we multiply the 84,000 by 8%, and we get up 6731. Notice how under a premium, the interest expense is decreasing over time. The difference is still $1,269. Now we're using up more of the premium more quickly. So now we're down to 82,868. Interest expense, because that value drops, interest expense is going to be less again. 8% of that beginning carrying value. Now the premium is $13.71. We'll calculate the final interest expense, $81,497 out of, or multiplied by 8%. Now we have $1,480 of premium amortized. Now the difference here, this one, it does round out a little weird because we rounded it to the nearest dollar. And for that matter, I'll tell you the price, the $86,400, that was actually a little bit off what the normal price truly would be. It would be a slight amount lower than that. But again, just for rounding purposes, we wanted to round to the proper amount. So what you would actually do in that final year, you would say, hey, we have $1,497 and we need to amortize the remaining $1,497. Now, that doesn't mean we can have unequal debits and credits. What that would mean is that that last year, the $8,000 minus the premium would give us our plug figure for interest expense. Now, I put that in there intentionally because in many classes, many textbooks, you're going to see this situation where the rounding is off in the final year. So as you can imagine, that would tell us that our ending carrying value is going to be exactly $80,000. So remember, we had to adjust that final year. We couldn't just use the calculations. You see the same thing with depreciation, the accelerated depreciation methods. You have to adjust in that last year. And that's exactly what we did. So that takes us through requirement 1. Now requirement 2, fortunately, is easy after you've done the amortization schedules. The initial issuance of the bond, it's going to be a debit to cash because we're increasing cash. We received cash. There's a credit to bonds payable, but there's also a credit to premium on bonds payable as well. This will be the same under both methods. The entry is identical under both methods, the initial issuance entry. And if we take a look at it, remember we sold it at $86,400. So that's how the entry would go there. Now, the journal entry itself, the design, the format of the journal entry is going to be the same under both methods. It's the amounts that are different. So we have interest expense. We're going to have to debit the premium on bonds payable to use it up. It started with a credit. We're debiting it to use it up. And of course, we're paying cash. So the good news is that that's the exact same entry itself for every interest payment. We still have the dollar amounts to worry about, but for right now, let's just put in the debits and credits, the format. Now, the last entry is a retirement. We won't deal with that yet. So from this point on, we can pull the information from our amortization schedule. So the good news is for straight line, every year is going to be the exact same amount. $8,000 cash interest paid, $1,280 premium, $67.20 interest expense. And then $8,000 interest paid. So under the straight line method, it's going to be the exact same. We can't do that for the effective interest method, though. We'll have to pull those separately. Straight line, once you have 1 year's journal entry, you have all years. The effective interest method, the cash interest paid is going to be $8,000 every year, but we have to pull a new premium or discount amortization and new interest expense for every year. So let's see, 8,000, 1088, 6912. Make sure these equal up to 8,000, and they do. Year 2, 8,000, 1175, 6825. Again, they equal 8,000. Year 3, 8,000, 1269, 6731. Year 4, 8,000, 1371, 6629. And finally, year 5, that's where we had the adjustment, 8,000, 1497, 6503. And just as a little hint, as you're going through these, the interest expense will always be higher than the premium or discount. So that should help you out there. So now we have the retirement at the end of year 5. Now keep in mind, this is a bond that was retired at maturity. So what this means is we're going to debit the bonds payable. We have to credit cash to show the payment. Now, at this point in time, there should no longer be a premium left over. So it's just going to be a bonds payable and a cash. And since it's at maturity, the carrying value, as you can see here, would have been $80,000 with no premium. That's the same under both methods. So what this means is that we have to pay $80,000 to pay this off. But that's it. So what this basically tells you is that under the effective interest method for a premium, the interest expense starts off high and gets lower as the years continue because the carrying value drops. But under the straight line method, it's the exact same amount for every year. So hopefully this helps to clarify the whole concept of bond amortization and the corresponding journal entries.